Hi, David. Thank you so much for coming to the Investor Talk.
Hello, David Mandel. I'm currently managing partner of Emerging Ventures. We're an early stage technology venture capital firm investing throughout the US, Canada, and Israel in emerging tech startups. Um, Prior to managing the fund, I was an active angel investor and still am. I've invested in over 600 startups throughout the last 8 to 9 years. As a full-time investor, I'm also very active with several angel groups, including Pasadena Angels and Tech Coast Angels in the Los Angeles area.
Thank you, David. Thank you very much for coming and for spending your time today with me. Founders will be very happy. Having someone like you is such a great experience. Let me ask you, you are based in America, in LA, California, but exactly in which area and geography do you prefer to invest?
So I'm based in Los Angeles. I've been in Los Angeles since 1985, so I'm partial to Southern California. Um, our current thesis, I've been branding myself as an anti-Silicon Valley VC, not because I have anything against Silicon Valley, but when I started as an angel, I was following the VCs in Silicon Valley, attended a lot of events there. I feel the accelerator programs there do an amazing job. The universities there do an amazing job. However, it got saturated and it became a bubble. And there's a lot of copycat startups, less originality, and higher valuations. So, and as a angel in LA and very active with the universities and angel groups here, I saw that in certain areas, such as the deep tech, the startups in our area were struggling to raise funds. There weren't very many VCs looking to fund pre-seed and seed stage outside of Silicon Valley. So I found that first locally in Los Angeles, and then through networking with other angel groups and syndicating deals, I realized the same is true in other areas. And that was my thesis 4 years ago. It's actually now a lot more well known. It's been all over the internet, especially during the pandemic. Many startups and VCs left the Bay Area and left New York and went to Florida and Texas and other places to work remotely. And with all the pitch events being online, it actually, the lines got very blurred now. And there's a lot of, Miami's a big startup base. Austin, Texas is a very vibrant scene. Boston, Massachusetts has always been for life sciences, but now is also for, tech and in general. Toronto, Canada is amazing in the deep tech and other tech, AI in particular. The universities, they're supportive, the government's supportive with tax benefits. So there are many tech hubs. And in fact, a startup does not even need to be in a tech hub with everything being virtual. There's many teams that are completely distributed. I mean, yes, it's still important to have the right structure. It is important for a startup to be a Delaware C Corp if they're in the US, and to have a law firm that is recognized for the startup world, an accounting firm that's recognized for the startup world, to set them up correctly. So they look like every other tech startup, so that become venture backable. So the VCs don't have to spend time and effort to see, does this work for me or not? You want to be set up just like everybody else, but where you are physically does not matter anymore. Not for access to VC and not for access to talent, because teams are all remote work from home in most startups. My personal thesis is it doesn't matter where a startup's based. It's not even a relevant question to ask them where they're based, because what does that mean? It's a debate we had. I'm on the board at Pasadena Angels. I've been a board member for the last couple of years after being a member for many years. And during the pandemic, we used to have a hard requirement that the founders that apply the startups, we would only fund startups with strong ties to Southern California. And usually that meant their headquarters are in Southern California. As we started to see that startups are everywhere, they often don't get a physical office. They're all working from home, and we want Delaware C Corps. So it's like, what does it really mean to be based in Southern California? Does it mean that one of the founders lives here? What does it mean? Because it's not a California corporation. So it's a Delaware C Corp, and the team can be anywhere in the globe. And so we really start to lose meaning to geography. I believe in this current global world, geography is of a business is a very blurry term. It is not a black and white term. It's a hard answer for a startup to sometimes tell you where they're based. I'll give you several examples. One of my favorite Fund One portfolio companies, I won't give their name, I'll just give a scenario. Doing very well, high-tech company, been funded by some very high-end joint venture programs from large corporate sponsor. My opinion, I would call them that they're based in Madrid. As far as I know, the founder and almost the entire engineering team are in Madrid, Spain. On their website, they have an address in San Jose, California. So they want to look like a Silicon Valley tech startup. And they're a Delaware C corporation. So they're trying to look like a traditional US startup. And they have all the right law firms and so forth. So their documents look like any other Silicon Valley startup. But in fact, I know that they're a Spanish company. In my mind, I consider them a Spanish company, but even though our fund doesn't do Europe, in this case, to me, it's a Delaware C Corp, so I'm fine. Their legal is fine. And in fact, their customers are global. They have a large Australian customer. They have several US Fortune 100 customers. They have several European customers. But who's to say, are they a Silicon Valley company? Are they a Delaware company? Are they a Spanish company? How do you define what they are?
Digital, digital, we're everywhere, and after pandemic, everything is normal. So,
geography is now not an easy answer anymore. Geography is a more complicated question, and in a sense becomes almost a non-question.
I agree completely. How much do you invest normally?
Our fund 2 is a $12 million fund. It's a small fund. We're still fundraising. We could oversubscribe to 20 million, but because it's a small fund and we want to make approximately 60 investments from that fund, our average ticket is about 200,000. It's just the math of 200 times 60 will use up the $12 million. We're investing a range of 100,000 to 250,000 typically on our first check into a startup. And we're typically investing in rounds where they're raising anywhere from $500,000 to $3 million. So we don't care if we're the first check-in or last check-in in the round, if we're the biggest check or smallest check. But if there is a lead or isn't a lead, we've gone into many rounds where there is no lead, and we each do our own due diligence. There's not always a requirement for a startup to go get a lead to lead a round. That's also a big misnomer. I talked to so many founders who are saying, I asked them, how long you've been fundraising? It's like, oh, for the last 2 to 3 months, we're working on this. And it's like, what's your traction? Well, we're still looking for a lead. I say, and what else is going on? Who else do you talk to? Say, well, we have 5 soft circled commitments. And did you sign them? It's like, no, we're waiting for a lead. And it's like, well, what are you waiting for? Why do you feel you need a lead? And they're like, isn't that how it works? I mean, they think that they need someone to lead around. And in fact, that's not the case whatsoever. There's many early stage rounds, especially if they're on safes or convertible notes, where there is no lead. You just start taking money and there doesn't have to be a simultaneous closing. So that's the biggest misnomer, the biggest piece of information I think I can give early stage founders is you don't have to look for a lead. If you want to raise $1 million, just go out there and say, I'm raising $1 million, and start taking, and someone says, well, okay, I'm good for 100. Okay, here's the document, here's my wiring instructions. And you got $100,000 in the bank, and you do the same tomorrow, and you do the same the day after. And a few weeks later, you have $1 million and you're done, and you never got a lead, and you don't need one.
That's true. It's completely true. Start taking, and after you can see, maybe one day you will find.
If you happen to get a lead during that period, great. But if you don't, you don't. There's no harm in raising $1 million with 10 checks of 100,000.
Absolutely.
It's the same $1 million, and now you have 10 investors that you can approach for help. None of them feel like your boss because they're all minority shareholders. You keep control, and everybody wins. You know, in the next round, of course, when you raise a bigger round, you're going to get a lead who's going to set a term sheet, and all these safes will convert into it at that time. And then that VC will take a board seat and have some other requirements. But at the early stage, just take money.
That's completely right. What are the top concerns, and where do you find the conviction when investing? The company, the team, the product?
Mm-hmm. All of the above. The main underwriting is kind of, I mean, obviously you have to like the product, you have to like the people, you have to like the business. It all has to be, but that's necessary but not sufficient. The main reason, well, first of all, we don't invest unless there's traction. So I need people that execute it. I need them to build an MVP and show me they can get people to pay for it. Show me that they're, they know how to sell it, can get people to pay for it. That's the most important thing for me is traction. I sometimes run across businesses where they've spent numerous years and a lot of money. So let's say I raised $6 million and I spent the last 4 years doing research, building a business plan, developing the IP. We have 12 patents in 3 countries. And it's like, well, where's the product? It's like, oh, that's why we're raising money now, so we can hire a team and build the product. I was like, okay, no, thank you. That's not for me whatsoever. And then on the other extreme, I'll run into a small team who only spent 6 months ago had the idea. They got together the team. They just built the MVP really fast and started selling. It's like, here, we built the MVP. We got 2 Fortune 100 companies to sign pilots that we're doing pilots with them. And here's the contracts, and it's all going well. And here's their contact. You can interview them. And it's like, I'm in. They can execute. They know how to get stuff done. No excuses, no delays, no business plan. They just get shit done. They get it done. And I love that. So I love the nimble, gritty teams that build stuff and ship, because they'll execute. They'll figure it out. They'll pivot. The final business model might look completely different than what they're doing now, but they'll figure it out and won't need a lot of money and won't need a lot of time to get there. So that's what I really look for in a nutshell. Then, of course, I have to reverse engineer. We're doing early stage investing. So I need to see is what happens next. So I have to put on the hat of, say, a large Series A fund and say, okay, if I was a large Series A fund and I was looking to write you a $5 or $10 million check, what would you need to look like? What metrics would I want to see? What would the whole company have to look like in order for me to write you that $10 million check? And then I look at that metrics and say, okay, now I look at this startup, I look at their projections, I look at all their capabilities and say, okay, what would it take for them to get there? Could they, and how long would it take? And what's the probability of that actually happening? And I can only invest if I feel like there's at least an 80% probability that they can hit those milestones in 12 to 18 months and actually get there. And then I want to make sure that they're raising enough money today to make it to there and not get stuck in between, because the most startups die for running out of money before hitting the next milestones they need to raise the next round. And so that's really, it's kind of reverse engineering and say, where did they go from here? Personally, for our fund, we need a minimum 10x exit in about 5 years. So I'm saying, okay, where's my 10x come from? Because I assume half will fail and half will have a 10x plus exit, and I average over 5x and my LPs are happy. But to get there, it's like, okay, first they need to be able to raise a large Series A, and let's say on average 18 months from now. And that will give me my first 3x markup usually. Sometimes it's a 5 or 10x markup right there, but at least a 3x markup from where we are now. So I say, okay, can they get there? Is this company moving fast enough and is this the kind of product and sales team with what they're building that can do that? And only if I answer yes to all those questions can I invest, no matter how much I like a team and a product or a company. Sometimes it seems like, that's a great business, but it might not be venture backable in the future. I don't see a venture capital valuing you 2 years from now at $30 to $50 million and writing you a $10 million check, and that you becoming a $300 million company in 5 years and having a great exit, so I can get like a 10x exit on that. And therefore, say that's a great company, you should run it, but it's not venture backable. And maybe, and I have to give that answer, unfortunately, many times to businesses that I like. I've gotten pretty far to like them, do some due diligence, but then have doubts about them being able to grow fast enough and have the right structure to receive a large venture capital funding in the future.
That's the point. How important is face-to-face meeting founders for you?
Well, the last 2 years, I've met very few founders face-to-face. I meet most of them over Zoom, as we're talking now. And that's been fine. We all got used to doing, the due diligence over Zoom, having founder meetings over Zoom. It's honestly a little colder. You don't build the same relationships as if you go out to their office in person, meet the team, spend a few hours with them, have lunch with them, maybe have some drinks with them, build a bond, talk about family. So it's faster and more efficient over Zoom, but you lose a lot of the relationship building.
Yeah, 100%. You need to find the chemistry, right? What is possible to have.
Yeah, and in fact, I'm finally now starting to meet up in person with some founders that I've been in my portfolio for 2 or 3 years. And one by one, slowly, they're like, "Oh, I'm going to be in LA next week. Let's meet up." And I'm finally grabbing coffee or lunch. Now that travel's opened up again, I'm starting to meet in person some founder, but it's not in the process of closing a deal. It's just after the fact. Hey, now that we happen to be in the area, or we happen to be at the same conference, let's meet up.
How involved did you get with your portfolio?
That's a good question. And it really depends on the founder and what they're looking for. I try not to take board seats. I don't want that responsibility, and I don't feel that at the early stage they really need outside board members. I would take a board observer. I really just care about information rights, getting quarterly reports and so forth. But other than that, I tell all my founders that I'm there for them as a free advisor. I don't need an advisory agreement. You can consider me an advisor by being an investor. If I sign on an investor, you have me also as an advisor. Reach out anytime, brainstorm with me on anything, use me as a sounding board. And some are first-time founders and need a lot of help and want a lot of advice, and some don't want any, and that is perfectly fine. So it's really up to them. What I often do is play connector, because I talk to so many startups, ones I invested in and ones that I'm not investing in. I can often see synergetic relationships with others, and I connect them always as a warm opt-in. It's like, hey, I have someone I think you should meet. Let me see if they want to meet you. And I reach out to both, and if they're willing to meet each other, then I connect them and let them take it from there. And it could be synergies in business. It can be someone going through similar problems. It can be one who can help the other as a vendor or a customer, of each other. And also for follow-on funding, I got to know some of the, Series A VCs who have funded other startups in our portfolio in the past. So I know who may fund certain others. So when they want to fundraise, I can sometimes make a warm intro to a GP at another fund. And also in the early rounds that I'm in, I can sometimes help them build a round by sharing the deal with others who are like-minded. And it's like, hey, I'm going in this deal and they have some room. Why don't you take a look at it? You might like it too. And we share the deal and help them get other investors. Funny enough, most often I wind up being a reference for them, often without them even knowing it, because I am there on their cap table, or sometimes even listed, on their press release and so forth. In the future, whether it's corporate customers or the next round of VCs, it will reach out to me either as an intro from the founder or without the founder knowing, just for a reference on them. And I spend a lot of time actually on Zooms or calls giving references on my portfolio companies. And particular, like say to the next round of VC to say how they behaved in the portfolio, how they report, how is it to work with them, do they do what they say, and so forth, or to a potential customer just about, whatever they want to know about any concerns they have, maybe about the financial stability or something or just doing kind of a matter of fact, just checking off the box of due diligence to say they talked to the investor. But I somehow get a lot of those calls or a lot of those intro requests as well.
You said before, will you lead the investments, and will you help the startups you are going to lead to get the next 2, 3, 4 investors to close this round?
Right. The official idea of leading as in issuing a term sheet that will then be used by everybody, I don't usually do, but I've often been first check in on a round that probably won't have a lead, and encouraging the founder to do so and even teaching them how to structure that kind of round. So, I will explain to them how to use a safe form. If they didn't know about that, then we're trying to do a price round and say, here, let's just do a safe. Here's the document. It's a standard form. You can go back to all the other soft circled people and and they can talk to me if they have concerns. I can explain to them why it's standard. If they're not familiar with it, say most will be familiar with it. If they're not, I'm happy to have calls with them. And as I said, sometimes I will also invite others to join around who I feel might have interest in it, who I know have done similar kind of deals, and who, so I share a deal as appropriate. If they want to fill around, I'll share a deal with associates.
During the pandemic, we've been talking so much about pivoting in order to avoid failure. What's your approach to failure when your startup will fail because someone of them for sure
Right.
will?
So I've seen a lot of situations. A lot of startups benefited from the pandemic as behavior shifted more to online and so forth. I've had at least one startup, one of our portfolio companies in the fund did fail due to COVID. They were completely dependent on sales to high security buildings, and their pipeline dried up when COVID hit, and they sold for less. They panicked and sold. Other than that, we've had some that had to put a hold, some that had to pivot, some that had to raise some bridge rounds. We had another security company that kind of had to retrench and just spend 2 years working on their product and not on sales, because the facilities they would be selling to, which were primarily office buildings, weren't interested at the moment in spending money on new technologies. So it hurt some, but in most cases, those were rare. In most cases, actually, the pandemic either was neutral or positive. Of course, in many other situations where it was enterprise sales, there was a period where if they were accustomed to making all their sales in person and flying around the country, if not the globe, and they couldn't do that anymore, they had to go back and say, how do I do this by Zoom? And after a few months of transition, they all figured out, both the customers and the startups that were, in this case, the sellers, the vendors, figured out that it's okay to do business by Zoom. They don't have to go out and meet in person and they can do all their presentations remotely and ship whatever they need to ship. And if it requires physical installation, sometimes that was a bit of a challenge. Such as, say, one of our startups that's in using drones to do inventory. Well, they have to physically go and do installs. And it was harder to demo and harder to set up the installs during COVID, but they just spent a few months instead, when they couldn't travel, working on the product and coming up with a new version and improving some of the things they wanted to work on. They made that priority instead of sales. And they raised a bridge round to cover the gap in the sales. And then now they're doing very well. They had a better product once they could sell again. And made up for the lost sales afterwards.
Why did you become an investor?
That's a good question. So I was an operator. I've built and exited 4 separate companies the slow way over almost 28 years, and mostly in finance and insurance. A couple of them got pretty big, and they're mostly underwriting kind of businesses. And so around now, by background, I was undergrad in math and computer science and graduate school in applied mathematics. And I really loved AI, wanted to work in AI. It just wasn't the right timing. In essence, was in grad school from 89. In 91, I dropped out. I got the master's, never stayed on for the doctorate, and decided not to get the doctorate and go into business and try business for a while because it just didn't seem like a good time to be in academics. And it's before the internet was cool, before AI was cool. And the short version, to jump ahead, I went into business and turned out great as far as success, business success. I learned that side of it, did well running businesses. But around 2011, 2012, to jump forward, at that time I had a big finance company and a big insurance company. And I was seeing vendors come to us with interesting products, different kind of products that didn't exist before, not your traditional tools. And they were starting to see like some real machine learning, AI, natural language processing. And it's like, that's really interesting. That's the kind of stuff I wanted to work on 30 years ago. And it was amazing to me that that exists now and it works. And we did some pilots with some of those, and they were in essence startups. I didn't even know that term then. But they were tech startups coming up with innovative solutions, not your boring Experian products, but some new startups giving you new alternative data, using your own data to give you insights using AI. And I was like, that's very, very interesting. I want to learn more about that. And I started then doing some angel investing and started talking to startups and went out to conferences in Silicon Valley, went up to the Bay Area, got to meet some GPs of funds, invested in some funds, learned about the accelerators. I really started to open my eyes to that whole field. Before that, I was completely naive to everything that had to do with tech startups and angel investing and all of that. I thought angel investing was really just like giving seed money to restaurants or something. I didn't know about the whole tech startup world. So the more I got into that, I got very excited. And then for a while, I actually thought, maybe I'll start a technology. So, we had a big tech team. It's like, oh, we should start like an incubator. We should build our own, some kind of insurtech products or something. And the more I learned about that, I saw all these amazingly bright people building the future. And I was like, no, they're much better at it than I am. I'm probably better off supporting them and being an investor in the next generation of technology. And I started doing some of that on the side. And the more and more I did that, the more excited got about that. And the less interested I was in my day job. I started to not enjoy my day job anymore. I started not like being in the office. So in somewhere around probably 2012, I already started to make the decision that I want out. I'm tired of insurance and finance. I want to be a full-time tech investor in some way. And started talking to investment bankers and doing a process. And by 2014, I managed to sell the businesses and was on for a transition still for a while and but I was, had my liquidity from my businesses and went full-time, decided deliberately to become a full-time investor. So it wasn't an accidental thing. It was a deliberate transition saying, I want to get out of operating my own businesses and become a full-time tech investor. And that's what I started doing. After the exits, I spent most of my time continuing to be involved in the tech world every way I can, went all in on being involved in every program, going to panels everywhere, being involved in everything, driving around everywhere. to learn what I like. And, and some of them I like and I want to keep on doing. And some are like, that's not for me. I won't do it again. But I tried everything. I went to everywhere, agreed to speak everywhere, agreed to be on judging panels everywhere, just to learn how everything works. And that was, now like 8 years ago. And that's 2014, 15, 16. Now we're in 2022. So time flies. And for a while after that, my former associates will always be like, what's next for you? What are you doing? I was like, nope, I'm not doing anything new in insurance. I'm very excited about technology. I'm doing all these angel investments. It's amazing. I really love it. I don't know if I'm going to make any money in it or not, but I love what I'm doing for now. And because initially, you write all these checks and you don't know what happens. It's my wife was always like, "Why are you doing that? You're writing you're putting all this money into something that you can't get back. You'll probably lose it all. Why don't you just buy real estate?" And but I kept doing it. And by 2019, I finally broke down, and I never planned to manage other people's money. I was doing it all with my own money. It's kind of a family office, and I had my holding company. And by 2019, I had enough, friends and former associates who wanted to co-invest with me. And I wanted to be able to write some bigger checks and have a little more formal process. So I started Fund One, Emerging Ventures Fund One, and got together basically close to 30 former associates as a partnership, and that was Emerging Ventures Fund One. We made 28 investments from there, and of course now we're on Fund Two. And I brought on one of my former investment bankers, Bennett Cole, great guy. He retired from investment banking and he came in to join me on Fund Two as a partner. So he helps with all the due diligence. And here we are. So that's kind of the story of how I went from an operator to an investor. But I think it's great that I've been an operator. I know what it takes to start and run and build a business. And I've done hiring thousands of times, so I can judge people and their ability to do work as if I'm hiring them. That I think helps. And the fact that I ran underwriting businesses and not so much sales businesses gives me an underwriter's mentality. So I have no fear of missing out. I'm okay saying no. I got used to saying no a lot, especially when I ran a auto finance company. I'm okay with not doing a deal that just doesn't feel right. I don't, not every deal that I like, I have to do. If I have doubts, my biggest logo, my motto in our building before was, when in doubt, say no. And I still live by that. I'm okay saying no very often, even to things that seem interesting. And if they wind up succeeding later, that's great. But I'm okay with the fact that I said no. And I think it's because I spent so many years as a professional underwriter that I have that mindset, which I worry about funds that are started by salespeople. They have too much of a sales mentality and too much. There's a lot of pressure. Like if there's a lot of signal on a deal, if there's a lot you want to follow, you're afraid to lose out. And to me, it's almost the opposite. I was like, I can't believe all these people are jumping in on that. That's a crap deal. But they're all, so I don't care if no one else likes the deal. I can be the only guy investing, but I'll write my check before anyone else does because I like it. I don't need signal that other people like it. And if too many people are liking it or jumping in and not doing any due diligence, that's scary.
Very much. What is the perfect recipe for a great pitch? You see so many every day.
Well, I might be a little different than other investors because it seems like so many pitches spend so much of the pitch deck or pitch time talking about the macro. They talk about the problem and that they're trying to solve. And they start at a very high level and they spend a lot of time talking about why there's a problem. And then they talk about the total addressable market and the serviceable market. And they might only have 3 or 5 minute pitch time at most pitch events, and they can spend more than half of that talking about the problem and rushing at the end to talk about their solution and their fundraising and their traction. So I think they spend too much time in general, on average, in most pitches, talking about the problem and not enough time talking about their solution. There's in fact so many pitches where I come away not even fully understanding what the product is. I understand what problem they're trying to solve, but I don't understand what they're doing to solve it and why it's unique or why they're the right people to solve it. So I would say really focus about yourself, what the problem is, how you learn why that problem matters to you, and how you're uniquely qualified to solve it. So because those are the things that are often missing, I think, from pitches. They can give a lot of data, a lot of stuff, and then be very particular and be very transparent. Don't exaggerate. Don't hide the bad stuff. It'll come out later and it'll be a big turnoff. For example, I'll see traction slides and I'll have logos of like Fortune 500 companies, and I'll say traction and I'll have all these logos. And you would think those are customers. And it turns out sometimes that they're not even prospects. They're like who they would think their ideal customers might be. And it's like, also, you have an amazing traction. How'd you get Pepsi as a customer? It's like, Pepsi's not a customer. They're just an example of who we'd want our customer to be. It's like, okay, well, why are they on your traction slide?
They're creative.
So they lose credibility with me right there. And I've seen that exact example several times. Where they kind of want to make them, and you might get more people to have meetings with you, but I think then you lose the really, I don't know. To me, that's a turnoff. I'd rather than be transparent. And if they've had a pivot, talk about the pivot. If they had a change, say, okay, we tried something, it failed, and we reset, and now we learned, and now we're doing this. I like that better than trying to hide it. So be as transparent as you can about everything. Would be, at least if I'm your target investor, that's what I would like. I like honesty and transparency, and I expect that because you're expecting me to be your partner, and I don't want to be a partner with anyone who is not honest with me up front. If not honest with me now, you won't be honest with me later. I can never trust you. So it's kind of like getting married. It's usually a 7 to 10 year partnership. And I'm giving you your money. I'm a minority shareholder. I have very few rights. You have all the control. I need to completely trust you.
Absolutely. What's your point of view on IP? Would you invest in a startup without any proprietary IP?
Yes.
Not belonging to them?
Yes. And most startups don't have any true IP. And I'm leery of the ones who spend too much time and effort on protecting the IP instead of launching a product. So I might be a contrarian on that, but I say, go build it. Your best defense is having good traction. You can build something and sell it that's better than filing patents. If you have $100,000 in 6 months, use it to build a product instead of using it to file patents. If it's either or. If you can get IP, that's great. Supplement what you're doing with IP, but that should be secondary, not primary, in my opinion. For most cases, it really varies by the industry and the type of product, but for most products in most verticals, IP is less important. You don't need to give away your secret sauce to anyone, including investors, honestly. But most of what you think is proprietary and confidential actually isn't. It really doesn't matter. Everyone's going to find out who your customers are one way or another. You already contracted them, so what does it matter? Let them be, give them testimonials. Let them brag that they're your customers instead of hiding who your customers are. If you have an exclusive with Coke, great. Be proud of that. Put it on your website. You'll get other customers. Instead of saying my customer list is confidential, it's not. But your prospects might be. If you didn't sign Coke yet and you're negotiating with them, maybe you don't want your competitors to know that. But that's a very rare situation. As far as other than that, code, you want to protect your source code. You don't want third parties having your source code. You don't want third-party developers. It's actually important to me that the CTO be in-house. A technical startup should have technical founders. You can't outsource the tech. That for me is a non-starter when you have a technical startup where they outsourced 100% of the tech, and the CTO is actually a vendor. That's an intellectual property issue, but it's also a operational issue. So that's a no-go for me. Other than that, I mean, unless you're a deep tech, like you're developing, if it's biotech or something, that's different. But in most normal tech startups, there really is no IP.
Hey, what's your suggestion to funders when approaching a VC? Not always they have a clear idea what to say, what to do.
Well, for me, I just want to see their pitch deck. Honestly, I get direct inbound. I probably get 30 messages a day just on LinkedIn from founders who say, "Oh, I have a startup and we're looking for funding." It's like, okay, send me your pitch deck. And a lot of times they say, "Oh, I want 15 minutes of your time to talk about my startup." It's like, well, 15 minutes won't do anything. And I don't want to talk to you unless I know it's a possible fit. 95% plus of the time, it won't be a fit. So why should I take 15 minutes of your time and of my time to talk to you? And it's like, send me the pitch deck. If I like the pitch deck and think there's a fit, then I'll schedule a meeting and I'll schedule 45 minutes because that's how long it takes at a minimum to kind of get to know each other and understand the business. So yeah, don't ask people for 5 minutes of their time. Send them a pitch deck. If you're worried about that and you think it's too proprietary, have multiple versions of a pitch deck. You can have a shorter teaser deck that doesn't have anything confidential and just high level, and then you can have a second pitch deck that's more detailed, that has granular financial information and so forth.
I'd like to close with a look into the future. What will be the most promising sector for funders to get involved in coming years?
Oh boy, I wish I knew, but the current, 2 years ago, I would have not realized NFTs and Web3 and everything that's going on in that space would have even been a thing. So, but right now, obviously, the hottest space is everything to do with what's being called Web3. And it's the blockchain and crypto and tokens. And particularly now, everyone's trying to figure out how to use NFTs commercially. There's a lot of startups getting involved there. Of course, everything in health tech is also big, but that's very saturated. I saw a statistic where in 2021, more money went into health tech than into biotech at the early stage. And I think that's scary. I think more money should go into curing cancer and doing the research than into making systems for telehealth. Yes, telehealth is coming and it's there and it's needed, and the pandemic accelerated it, but we don't need 5,000 different telehealth systems. We need a few good ones. And, 4,900 will die if there's 5,000 of them. So I wouldn't start another telehealth company or another health tech company. There's a health tech solution for everything now. And same with Web3, there's every day 5 new type of NFT marketplaces coming out. Everyone's trying to make it easier to mint and mint NFTs, resell NFTs, monetize NFTs in some way, trade them, make them more accessible to the public. And yeah, there's some need for that, but there might be too many startups, each just trying to jump in on the current craze without differentiating themselves too much. They're getting very niche on verticals, maybe. Like, oh, we're for singers, we're for bands, we're for this, we're for that. But I don't know. I'm skeptically looking at them. I did invest in already 2 NFT related startups that are doing something in that space, helping mint and create marketplaces for them. I think there's too many of those. I think there's too many tokens out there that, well, unlikely to get a lot of traction. Maybe there'll be a couple winners. So I'm skeptical of that, but there's a lot of them. I think true AI machine learning as applied to particular verticals is great. The same thing with blockchain. I'm not seeing enough good blockchain applications. They jumped from trying to use blockchain to solve business problems to now NFTs and tokens. And I think there's some real good use cases where decentralized ledgers and or smart contracts or both can really improve a business process. The way AI improved a lot of business processes already with automation, whether it's accounting or whatever. So we have there's one startup in our fund too that is doing construction software on the blockchain using smart contracts. And it really helps large construction projects run more efficiently. I think there's a lot more use cases like that, and I don't see a lot of that. I see very few legitimate blockchain projects coming out. Ever since NFTs took over, everyone forgot about blockchain and jumped straight to NFTs. That was working in Web3, and that's a shame. So I think there's an opportunity there. If anyone's listening that has blockchain experience and is developing on smart contract experience, instead of working on NFTs, work on solving business problems, in particular verticals, which there's hundreds of niches and hundreds of industries where you can make the whole processes run more efficiently using the blockchain and smart contracts.
What's the point of view, and promise I close here, on metaverse?
Oh boy. It's the future. It's coming. It's kind of here. Who said it? It's like someone famous said, if the future is already here, it's just not evenly distributed. And that's kind of true of that. There's some people that are already kind of living in there in some way or another, especially the younger generation of gamers. They're the first to adopt. They're kind of literally living in the metaverse. And one version of it anyway, whether it's Sandbox or there's these platforms out there that are getting people, and the whole idea, and that mixes with NFTs and digital goods and digital property and marketplaces for the digital properties. We need to work on some standards on interchangeability, the ability to port. So you have an NFT, like say you got so for brands to get in on it, say Nike or Gucci are early adapters on that. You can, in certain games, in certain worlds, buy a Gucci sweater for your avatar. Yeah. And Nike shoes for your avatar. And you're paying real money. You can pay like $30 to get a Gucci sweater for your avatar on the platform, but you want to be able to take that Gucci sweater anywhere. Yeah. And right now, there's still some barriers there. The portability is a problem. They need to work that out. There needs to be some standards coming around for portability to really make that adapted. But that's going to be a big deal, because as we spend more and more time in there, how we look and what status symbols we have in the metaverse will matter even maybe more than in real life. So that's going to be a big opportunity. I don't know which brands will win, but a lot of real brands are spending real time and effort on it and being early adapters. As I said, Nike's going real big on it. And I saw brands like Gucci going in it, and there's many others, but those two come to mind as ones that are really active right now. And there's been millions and millions of dollars spent on NFTs, but there's also been millions of dollars spent on buying real estate, in quotes, in the metaverse in various worlds, and none of them are transferable or compatible in any way, and a lot of those worlds might not survive, but people are betting that certain ones will, and they're spending some pretty big real world money to buy land, in essence, to buy property, to buy visibility in, and sometimes to buy advertising and so forth in that metaverse. You want that prime property, you want the prime billboard, you want the storefronts. It's a whole nother thing. What happens next, I think, is the hybrid. I think there's more opportunity for augmented reality in the near future than virtual reality. If I see that having augmented reality in one way or another, where you're overlaying digital on top of the physical, being interesting. And there's a whole new set of problems there, like ownership rights. Who can sell you rights to a digital billboard on my building in your metaverse? You come up with this new augmented world or augmented reality glasses, and now you can walk down, you can really sell a digital overlay for everything. There could be a billboard, but now you don't have to see what's on the billboard physically. When you're walking by it with these glasses, you can see a different billboard, a different image on that billboard. Who has the right to sell you that?
That's very fascinating.
So that whole, there's a lot to be worked out. There'll be a lot of battles. I don't know who the winners are going to be, but that's a space that I'm very interested in and that I'm paying attention to, and be happy to invest in several different guys who seem to be solving it right, to see what, because their winners can make really big money there. That's some real unicorn possibilities, and it's coming soon. It's really here now. It's here, but not here, but it's here. It's just not fully adopted. It's right around the corner. It's not like a decade away. It's really going to be here sooner than we think. And obviously autonomous and vehicles and autonomous VTOL. So, basically drones that are autonomous, and whether it's starting out with deliveries, and then, but before we know it, we will have air taxis, and that will be very interesting. I mean, the day you can land at the airport and then take, in essence, a big drone that takes you and 5 other people to what used to be a parking lot, but they now converted it to a drone landing zone. Call it an air taxi, right? Or air Uber. That day's coming, and it's not that far away, because they're working out the air traffic control for it. And it's all about the AI doing automated large-scale air traffic control to manage the flight paths of thousands of drones simultaneously in a tight airspace.
I'm very excited what I'm going to see in the future. David, thank you very much for coming to the Investor Talk. It's been a very good pleasure for me.
Yeah, thanks, Max. It was a pleasure being here.